Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to mid-year purchase of controlling interest. Up until this point in time, we've been assuming that the purchase takes place within our practice problem at the beginning of the year so that we have a full first year of the consolidation. This time, and many times you've probably been asking, well, what would happen if they purchased it in the middle of the year or sometime other than the beginning of the year? That's what we'll take a look at now. Mid-year purchase of the controlling interest. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area on the right-hand side, including our worksheets and our entries. And then we have our consolidation worksheet. Let's see what we have on the left in terms of information. It's going to be a mid-year purchase of the controlling interest. That means that P, the parent, is going to be purchasing not as of January, but sometime in the middle of the year. This is going to be after the first quarter for this example problem. So therefore, we're going to need to split up basically the income. That's what this first item is going to be doing. We've got the 2000x0. We've got quarter one sales, quarter one expenses, and quarter one dividends. Then we have the April 1st, 2000x0. That's when the parent purchases the percent of subsidiary common stock. So the purchase took place right after the first quarter in April. So that's going to be an 85% interest. Therefore, at that point in time, after the first quarter, 85% controlling, 25 non-controlling. The cost, $765,000. Fair value of the non-controlling interest is going to be $135,000. The shares outstanding, 100,000. Par value 1. Original issued at $6. The differential, when we calculate the differential, we will attribute that differential to be Goodwill. We'll see that shortly. And then the S retained earnings as of 2000x0, basically the beginning of the year to the end of the year. There's basically the statement of equity is the 145 at the beginning. And then we have the 170,000 net income, the 36 dividends, and then the ending component is then going to be that 279,000. So you can see that reflected over here. This is the trial balance for S as of the end of the year, 2000x0. So the beginning balance here will be the beginning balances here. So we've got then the 145,000 in the retained earnings, 145,000. We've got the net income is going to be the net income here. We've got the dividends that went out is going to be the 36,000. And then if we take the total, we're going to say that's going to be the 279,000, which will be retained earnings once the temporary accounts are closed out to the permanent ones. Now we're going to do the equity method is what P or parent is going to be accounting for S using. Let's first consider that equity method. To do so, let's hide some cells. I'm going to hide some cells from H to K. So from H to K, we're going to go select H to K, let go, right click the selected area and hide. So now we want to reconstruct basically this number P that P has on its books, the parents have on this books, and the income from S. Now this is the first year that the purchase took place, so we should have all the data. We should be able to construct fully both those numbers. However, it's a little bit more difficult than prior presentations or prior examples because the purchase took place in the middle of the year. Therefore, we will have to account for that. So what we typically do first off is we say, all right, let's look at the income or let's look at the investment that happened, right? The investment took place this year, so that's straightforward because they paid the cost of $765 for the 85% interest. So we're going to say that is what it is. So that's going to be increasing the investment account. Then we typically apply the net income, but this is where it's going to get a little bit more complicated because of this mid-year type thing that happened here. So we're going to say, all right, then usually the investment account goes up. The other side is the income from S. Typically, we would take the net income on the year and then take 85% of it. But we're going to have to do a little bit of an allocation, a little bit different here down here. So I'm going to do we're going to go down here and do a little calculation on this. So we're going to say the net income, I'm just going to say equals, and I'll pull it from here. I'm going to put this in the outer column. I'm picking up that 170,000. This is the revenue minus expenses for the entire year. So that's going to be the 170,000. Then we're looking at the first quarter information. First quarter information, we had the sales up top, and we have the expenses. Sales and the expenses. Pulling over the numbers, I'll pull that into the inside. We'll do a little inside calculation here. The 244, I'll make this one a negative for the expenses. And so there we have that. And then I'm going to call this Q1 net income. And we'll sum that up, or revenue minus the expenses, sales minus the expenses. That's going to give us our 60,000. That's going to then give us our subtotal. The outer column here is going to be equal to the 170 minus the 60,000. That'll give us our 110. That's the net income to be allocated, because obviously this is for the year. We pulled out the first quarter. This then is for the 3 quarters where P is now involved. P is in the game on the first 3 quarters, and they own 85%. So of those 3 quarters, they're picking up 85%, we're going to say, because that's what they should be picking up. And then that's going to give us the net income allocated to P being the 110 times the 85. 110 times the 85. So now we're going to be putting that up top. That's what they're going to be recording in their equity method transaction. So once again, instead of just the 170,000 net income times the 85%, we're pulling in this 93.5 as calculated just now. And then we're going to do the dividends. So typically the dividends will be cash going up, and then the other side is going to go to the investment account. Is going to be the typical journal entry. For the dividends, normally would be the 36,000 times the 85%. However, 13,000 dividends went out before P was involved here. So I'll do a quick calculation down here, and then I'll just leave the calculation in a formula in this cell so you can see that in the worksheet. I don't think we need a full little table here. So we're going to say this is going to be the 36,000, and then we had the first quarter that's not going to be included because S wasn't there at that time, or P wasn't there at that time. So there's the 23,000 dividends that went out when P was there. So if I take that 23,000 times the 85%, their controlling interest, they should have got 19,550. Let's do that with a formula up top. I'm going to say this is going to be equal to brackets of, we'll be picking up that 36,000 minus the 13,000, and then multiplying that times the 85%. There's the 19,550. Just same calculation that we did down here. Just putting the formula in this case, in this cell, so that people can see it in the worksheet there. And I think that'll hopefully be enough. And so I don't think we need this. So I'm going to delete that. So there we have that. Now let's go ahead and see if we have indeed reconstructed this account properly. If it's reflected what's on the trial balance. We're going to have this investment account here, plus this investment, plus this investment. So there's the 838,950. We have indeed reconstructed it properly, which is an exciting that we completed that task. And then this one's going to be the 93.5. So the 93.5 is going to be this item reflected. Now that'll help us out when we do the elimination entries and whatnot. So now let's calculate the Goodwill. So let's go to Goodwill down here. We like Goodwill. Bad will's no good, but Goodwill is good. And so we're going to do a similar kind of calculation we've seen, in the past for the Goodwill. We're going to say that we have the compensation from P. So how much did P pay for this thing? P paid $765,000, and then we had the fair value of the non-controlling interest. So because they paid for 85%. If you think about the non-controlling interest, it was $135,000. So that means on a market basis, then, because it's basically a market transaction, the thing's worth the fair value of the total fair value, the $900,000. So $900,000 total fair value. We're going to compare that to the book value, what's on the books. Now, when we think of the book value, we have to think of it as of the point in time that the purchase took place. And the purchase took place like on April 1st, which is right after the first quarter, like in the middle of the year, which is kind of funny. So what we need to do then, what we're going to do is we're going to think about, okay, where was the book value as of the beginning of the year? And then we'll remove the first quarter information. So we'll think about book value as of the beginning of the year first. We have the statement of retained earnings here, or we can take this from the trial balance, because these numbers represent the book value, because as of the beginning of the year, because the temporary accounts have not yet rolled into them. So we can pick up these numbers, and I'll pick them up from the trial balance. I think that's easier to see. So I'm going to say the common stock is here. I'm going to copy that. I'm going to paste it down. We got the additional paid in capital retained earnings. So I'm going to be saying negative of the 100,000, negative of the 500,000, negative of the 145,000. So there we have that. And then we have the Q1 earnings that are not distributed. So we then need to think about, what were the earnings for the first quarter, because these three numbers then would reflect assets minus liabilities basically as of January, as at the beginning of the year. Then we need to think about the earnings for the current year, add them in, which is going to be revenue minus expenses for the current quarter. And then we need to think about the earnings that have then been distributed. So whatever earnings were there in the first quarter would increase the book value by the net income, kind of roll into the equity section. And then the dividends would be decreasing that value because it got distributed out before P came into the game, and therefore we got to reduce it by that. So I'm going to do that with I'm going to say this is going to be equal to sales minus the expenses. That would be, I believe it was 60,000, same calculation here. And then we're also going to remove the dividends that went out of that 60,000, the 13,000 dividends that P is not going to be taking part of. So that's going to give us the book value for April 1st. So April 1st, book value. It's not a joke here. This is what it actually is. And we're going to say this is the sum of these. And that's going to be the 792,000. And then we'll calculate the good old Goodwill. Good old Goodwill is going to be here, and we'll subtract that out. So this is what the fair value is minus the book value. That gives us the 108. All right, so there's the Goodwill. Now we're going to go to the non-controlling interest in net income. That's going to be this account. We're going to basically calculate what will be in that account after we enter our consolidation entries. So we're going to start off with the net income here. So we'll start off with the old net income. And that's going to be the 170,000 again, as we've seen in the past. Then we're going to take into consider the first quarter data. The first quarter data, we're going to be pulling out the first quarter data once again. And we'll see that in the consolidations shortly as well. So that's going to be the sales, the expenses for Q1, which is going to be equal the sales amount. Let's make the expenses the negative of. And that's going to be, once again, of course, our 60,000 Q1 net income. And that's going to be, I'll just call it Q1 net income. All right. And then we've got the net income to be allowance, or I'm going to allocated is what I want to call it. That'll give us the net income to be allocated. So we have the 170,000 minus the 60,000, giving us the 110. You can see the calculation up top. We took 85% for P's portion. Now we're taking the portion for the non-controlling interest, which of course will be the difference between the 1 and 85% or 15%. So I'm going to say this will equal 1 minus the, let's pick up the 85% controlling interest. And that'll be the 15. So that 110 then times the 15. That's going to give us our non-controlling interest in S. So that 16,500, that's what we expect to be here at the end of the process. So let's go ahead and continue with that process, doing our closing or elimination entries. I'm going to unhide some cells. We're going to unhide from F to L. So I'm going to select F to L, full, and then right-click on that full, and then unhide. So there we have it. So now we're going to do our elimination entries. Now, when we think about this, we've got P and S. These are the trial balances for the full year of 2000 X0, the year that P, parent, purchased S, but the subsidiary, but the purchase took place after the first quarter. So we got the full year for the parent, we got the full year for the subsidiary. However, P's only, been in the game on the subsidiary side of things for the last 3 quarters. So really we're going to think about, well, maybe we got to kind of adjust for that, and we'll think about that shortly. First, let's go ahead and sum up this column. We're going to sum up this column like we normally do. So this is for the full year of P and S. That's going to be our starting point. I'm going to go ahead and paste that out, copy and paste that out. So there's our starting point. Now we're going to remove the sales and the expenses and the dividends that happened during the first quarter, the activity in essence, the activity that's happening in the first quarter. So, and this will because the parent doesn't have any responsibility for those. So we're going to remove those. And notice this makes sense because if we didn't do that, notice that these accounts that P is recording with the equity method are not reflecting the first quarter data because they came in after the first quarter. They reflect the second. So we have to, in order for the thing to match out, we'd have to pull out the first quarter basically information here. So that's what we'll do here. We're going to say, all right, the sales then needs to go down by the first quarter information, which is going to be that 244, and the expenses, which we grouped into this one expense account here, is going to go down by the expenses for the first quarter, which is the 184, and then the dividends that were declared need to go down for those that happened in the first quarter, which were the 13,000. And we're talking sales, expenses, and dividends. Those things roll into retained earnings. So the other side of this thing needs to be going into retained earnings is going to be the difference. So if I add those up, we're at 47,000. That 47,000 is going to be here, negative sum of these items. So there we have the 47. All right, let's record this out. We've got the sales up top. So here's the sales. That's going to be down here in the sales area. I'm going to say that equals the 244. So now sales, this 656 is going to be reflecting the last 3 quarters that we will be dealing with. Next, we have the expenses. So the expenses are going to be here. I'm going to say that's going to be equal to this amount. And that means this represents the expenses for the last 3 quarters or left. Then we have the dividends. The dividends, 13,000 are going to be removed. So now we have the dividends for the last 3 quarters. And the difference then going in to retained earnings. Retained earnings is going to be credited for that 47,000. Okay, so now that we have that, we're going to go into our normal kind of what would typically be our first entry to our elimination entry. So this will typically be our first entry. I'm going to say, okay, this will be equal to, I'll be picking up the investment account. I'm going to get back to the investment account later. I'm going to go then down to the common stock, the additional paid in capital, and the retained earnings. Let's pick those up. So we're going to pick up the common stock. We're going to pick up the additional paid in capital. We'll pick up the retained earnings. Now, the common stock is going to be, it's on the books here as a credit. So we're going to debit it to remove it. Debit it to remove it. Additional paid in capital is on the books as a credit. We will debit it to remove it. Now, here it's a little bit more confusing because the retained earnings is the 145. We're now going to be picking up that 145 here and the 47,000 to get to the 192. Now, I'll try to do that with a formula so that you can see that. So I'm going to be picking it up. I'm going to say it's going to be equal to negative of that 147 minus this 147 up top. And then when you work on the Excel worksheet, hopefully you'll be able to see that in a formula. That's going to be the 192. Then we've got the dividends. So the dividends here, we're going to be picking up same kind of business. We've got this 36,000, and then we've got this 13. The 13 for the 23. It should be this 36 and that 13. I can't pick up this 13 here because in a formula, because if I post to it, I'll get a circle reference. So I'll try to pick that up over here as well. This is going to be equal to, I'm going to say negative of this 36,000, and then I'm going to say minus this 13, and that's going to give us our 23, and that should be on the other side. I'm going to cut and paste, and then copy and paste. Okay, so that's going to be the 23,000, which are, I'm going to pick up those 2 cells. Shouldn't cause any circle reference problems. Then we're going to say that we have the income from S. So the income from S is going to be that 93,000. Now, we have the 93 that you can be picking up here, or we have the calculation of it down here. So in other words, normally we would take the net income 170 85,000 times the controlling interest 85%. However, this time we got to take into consideration the first quarter's not there, which we did in this calculation. So I'm going to pull this from the amount down there. I'm going to say this is going to be equal to this item. So you could see that calculation if you're in the Excel worksheet here. And then we're going to go to the non-controlling interest, and same kind of thing. Normally we would take this 170,000 and then multiply it times the non-controlling interest would be 15%, but we also did the calculation on that here with the 16.5. And so I'll pick that up down below. So I'm going to say this is going to be equal to this amount. Now note, if you're thinking here, I mean, basically the calculation note is going to be, you know, if you want to think about it from the trial analysis, the net income and then the adjustment that we just made, which is at 110,000, which is now being pulled out between the 0.85, this times 0.85, right, and this times 0.25. So that, sorry, I'm going to say this times 0.25. All right, should be times 0.15. Okay, that's going to be our 16.5. And I've had 25 stuck in my head, so it should be 85.15. So if I have mentioned that in the past, apologize for that. But there we have that. That's going to be basically those two. Then the non-controlling interest down up here on the balance sheet. So non-controlling interest on the balance sheet, and we're basically allocating now these amounts to the controlling and non-controlling interest. This amount then being the 879,000, which is equivalent to assets minus liabilities, the 879,000, or the equity section, the 879,000. So I'm going to say this is going to be negative. I'll say sum of, and I'm going to pick up the assets minus the liabilities, and then times, and I'll say 1 minus the 85%. So there is that item, and then I'll go up top and I'll pick this one up, and this is going to be now the other side of it equals the sum of, let's pick up that again, this and this, and I'll say times the controlling interest, which is the 85%. So that should do it. If we add those up, adds up to 0, looks good. Let's go ahead and record this. So we have the investment in S. So investment in S, it's going to be up top. It's not going down to 0 quite yet, but that's okay. I think we'll be okay. We'll get there. And then we've got the common stock. So we're picking up the common stock to record the common stock. So it goes down to 0 because not much activity we're showing here on the parent company. So it went back to parent's balance, which is 0. Then the additional paid in capital, which is going to be equal to the 500,000. The retained earnings now. So notice the retained earnings already had that 47 in it. So now we're going to say plus the 192. So that one's going to be a little bit different the way that came about, but we're still at the 970, which is basically the retained earnings for P. Then we're going to go to the dividends, the 23. Double click, we're going to say plus on the dividends, and we're picking up that 23 credit. And once again, it was a little bit different the way these two journal entries play out, but we're still basically at the dividends being zeroed out here. Then we got the income from S. So income from S down below is going to be the 93.5. That goes to 0, as we would expect to happen by the end of the problem. And then we have the non-controlling interest in the net income being recorded. And then finally, the non-controlling interest in the net assets, which is going to be the 131,850. That then, of course, puts us back in balance. All right, now let's go ahead and record the goodwill that we calculated. We had goodwill down here. Good old Will. Will's a good person. Goodwill. So we're going to record goodwill on here. So let's do that. I'm going to say that's going to be an asset. It's going to be goodwill, and that's going to be equal to the calculation we did down below, which is the 108. We're going to be breaking that out between the investment in S and the non-controlling interest in NA, basically the balance sheet accounts for the controlling and non-controlling interest. So we'll be picking that up in the investment in S and the non-controlling interest in NA. We're going to be picking that up from the 85.15. So we'll say negative of this number times the 85, and then negative of this number times, I'm going to say 1 minus the 85, which will be the 15. Okay. And then that should add up to 0. That looks good. Let's go ahead and post it. Here's the Goodwill. Goodwill's up top. Let's go ahead and post that out. Goodwill now on the books at the 108. We have the investment in S. So the investment in S, something's in it. I'm going to hit F2 plus F2. So I can then use the pointer buttons, arrows, and that brings it down to 0, which is what we expected to happen. So that's good news. We're excited, really excited about that. And then we're going to go into the non-controlling interest and the net assets, F2 plus F2. We'll pick up that 16,200, and that'll bring us back to 0. So at the end of the day here, we have this account going to 0, the investment account. We have the income from S going to 0 as would be expected. And you could see basically the common stock or the equity section still matching, in essence, the parent equity section here.